Hey guys, it's been a big month of data. Let's start with the budget last week. We saw a pretty benign budget. There was obviously some tax benefits in there with the change in tax thresholds. So for a couple earning $150,000 a year of income, they're going to get about an extra $2,000 a year in their back pocket, or roughly $40 a week. It's not really going to dent the side in terms of where mortgage rates are at the moment and how hard it is for you to service your mortgage, but it all helps. At the moment, the best mortgage rate we're seeing out there is a 1-year fixed rate at 6.85. It definitely pays to shop around it a little bit, and if you've been with the same bank for a while, then I would certainly encourage you to contemplate refinancing because there are good cashback offers out there. As far as the other news is concerned, the first home grant disappeared. So for first home buyers, if you met the income and purchase price criteria, you were able to get an extra cash incentive with your KiwiSaver. It was up to $10,000 per borrower for a new build, which was really attractive. That's gone. We didn't really have too many of our clients able to access it because it didn't really work in the Auckland market with how high house prices are and how high incomes are. In provincial New Zealand, it will be missed. I don't think it was driving that part of the market. I think it was a bit of a free gift. The reality is there's a first home scheme that's still out there under Kāinga, which allows people to buy a first home with as little as 5% deposit, and it's underwritten by the government. So you get good mortgage rates and you still get cashbacks, and that's still out there. In other news, today actually, we saw a pretty decent spike, I think just over 7% spike in mortgages that aren't performing, taking that up to $1.9 billion. Not really surprising when you think about the number of households now that are struggling with these high rates. It's definitely coming through in the data. Other data out recently, we saw business confidence drop another 4 percentage points before the budget last week. And consumer confidence, whilst it's increased a little bit, it's still really, really weak. We continue to see weak GDP. We continue to see really weak retail sales. And I don't think that stuff's going to disappear anytime soon. So we had the Reserve Bank come out 2 weeks ago with its OCR, sort of jawboning the market, sort of trying to hold those wholesale interest rates up, concerned that wholesale markets had started to anticipate falling rates already. Their view that they put out there was that they don't see the OCR decreasing until the end of next year. Now, whether or not you believe that or you see that as jawboning the market, I'll leave that for you. My view is that the economic data I'm seeing, what I'm seeing out on the street, the dramatic increase in non-performing loans over the last year, which I think is up about 70%, all of this data tells me that the Reserve Bank's going to have to take action towards the end of this year or early next year. The big number that they're looking at is the inflation number. Now, unfortunately, our data is so backward looking, they're generally reporting 2 or 3 months in arrears, right? So the first real opportunity for the OCR to decrease will be in November, when they've got that third quarter inflation number out. Most economists are expecting that to end up with an annualized rate below 3%. So if that happens, that's my pick for when we might see the OCR start to decrease. As far as the housing market's concerned, it's a really interesting market at the moment. We've had a lot of listings. A lot of people are getting more realistic about selling. We've got a lot of excess stock left over from development activity over the last couple of years that's sitting in the market, that's holding prices down. Along with the high interest rates means that borrowing power is somewhat limited. So nothing's really going to change there. I'm expecting the rest of this year, the housing market's going to be flat. You may even see little declines depending on what part of the market you're in before it stabilizes towards the end of this year. Next year is going to be a better story. We will have lower interest rates. We've had lower building activity over the last sort of 12 to 18 months. That will start to flow through as well. So lower interest rates, lower building activity, a little bit of immigration equals house prices stabilising and starting to increase again. Most economists seem to be picking house price inflation next year of somewhere between 5 and 10%.